Mэтт Sимpson from Black Iron is with me on Skype now. Matt, thanks very much for taking the time. Good to see you.
Good to see you also, Andrew.
Matt, of course, your main project in Ukraine, Shymanivske, you took it right through to bankable feasibility in 2014, and you had Ukraine's largest company, Metinvest, ready to fund half the construction costs. So things were really ramping up there, but you were forced to put it on ice in 2014. Talk us through what was going on and what led to that decision.
Yeah, you're right, Andrew. We were on the brink of actually starting construction of this mine. In addition to having Metinvest looking to finance half the construction cost, we also had an international trading company come to site at least 4 times who are looking to do a prepaid offtake agreement with us that would have rounded out the financing. And then unfortunately, Russia invaded Ukraine. And once that happened, it really just caused us to take a big pause because we need to get some clarity on what was going to happen in that case. And then subsequently, iron ore prices fell quite a bit from $95 all the way down to $37.
And so having to go quiet for 3 years while events were playing out there, it must have been difficult. It must have been frustrating for you given the potential of the project here.
Yes, I mean, it's never easy to have to wait things out when you know you have such a good project and you're so close to starting construction. We had built our team up to do so. But unfortunately, the best thing for our shareholders really was to just wait, preserve cash. We actually downsized our team, downsized our board, took some salary reductions because we knew that there was going to be a day when things were going to turn around and want to make sure that we had a strong balance sheet to be able to push the project forward again.
And you reckon that day may have come? I mean, the situation politically hasn't changed too much, but iron ore prices, they've since rebounded. Why have you chosen now to kick off the operation once again?
There's a number of reasons why now we believe is the ideal time to kick this project off again. As you mentioned, iron ore prices definitely have rebounded quite nicely. Since around October of 2016, they've averaged well above $70 a ton, and today they're sitting at around $77 a ton, which is quite nice. In terms of the war in Ukraine, we believe that Putin achieved his objective. He took Crimea, which is where his naval base is located. He then invaded the eastern part of the country, an area called the Donbass, and that was largely to have some influence over Kiev. And then over the last 3 years, that front line hasn't moved at all. So there's no reason to think that it would move. If Russia wanted to have invaded the rest of Ukraine, they would have done it by now. So that gives us comfort on the political side. The third factor, Andrew, that's quite important is also the exchange rate. In 2014, when we did our feasibility study, the exchange rate was around 8 hryvnia to $1 US. And today, it's distressed to the point that's now 26 to 1. So to put that in perspective for you and for some of the viewers, in 2014, when we did our feasibility study, our estimated operating cost for the project was $45 a ton. And there's a pure play iron ore producer that trades in London called Fair Expo. And in 2014, their actual published cost for the full year was $46. So very, very similar. However, in 2016, because of this distressed exchange rate, Fair Expo's published operating cost was down to $28 a ton. So that's an $18 decrease, all because of exchange rate. So in 2014, when we published our study, the broker consensus iron ore price was $95. And as I mentioned earlier, it's now $77, which also just happens to be $18. So the exchange rate is pretty much offsetting iron ore price, but our construction capital is going to be even lower.
Oh, very good. And I suppose, Matt, it's also worth pointing out, just sticking with the locality in Ukraine for a moment, the part of the country you're in, that's relatively stable. I mean, life's going on for many. It's business as usual.
Yes, that's absolutely correct, Andrew. I mean, our project is 450 kilometers away from the Donetsk-Lugansk region, which is the area where the conflicts are occurring. I've been to Ukraine several times personally over the past 3 years to visit our site, visit our employees, and it very much is life as usual. Mom and dad are going to work, kids are going to school.
And I suppose it's not really, or you're not really the only person who reckons now's the time, or the time is right at least, to get back into business. So a big name on your doorstep, ArcelorMittal, also an iron ore producer. They've just announced a big investment deal. We're talking around $1 billion over the next 3 years, aren't we?
Yes, that's correct. ArcelorMittal's operations are only 1 kilometer north of us, so literally on our doorstep. And they acquired that mine from Ukraine's government in 2005 for just shy of $5 billion US dollars. And it's been a very, very profitable operation for them, which is why they are now announcing this $1 billion investment, of which they're going to spend, to my understanding, about $275 million this year.
And as you know, we've had the call out for viewers to send their questions, and one in particular, keen to know a little bit more about the project itself, the location, infrastructure, the labour situation. What are some of those details there, Matt?
Sure. Well, I think it's important to start off by saying that iron ore is not a rare commodity. Iron ore is found in quite a bit of the Earth's crust. What really makes an iron ore project special and interesting, though, is can you get the product out from your mine site to your customer in a cost-effective manner? And to do that, because this is a bulk material, you need rail, port, power, and skilled labor. And that's what really separates this project apart from every other developing iron ore project out there, in that the government-owned railway and power lines with confirmed capacity for our project are only 2 kilometers from our site. And that rail takes you to 5 different ports on the Black Sea, with our port being called Yuzhny only about 400 kilometers away and being able to take those very large Cape-sized vessels. In terms of labor, we have a highly skilled population, 750,000 people to be specific, only 20 kilometers from our site, where that skilled frontline laborer makes a fraction of what you'd pay people here in Canada, Australia, or Brazil, which are the other big iron ore producing nations.
And given the close proximity here to the railway and power lines, does this mean you can construct it in smaller, low-cost phases?
Oh, absolutely. Our plan now is not to look at building a 10 million ton a year, close to $1 billion type plant, because the market just isn't there for that right now. What's really interesting about our project is that you can build it in much smaller phases. So we're thinking about an initial phase of probably around 4 million tons a year of production. And we can do that again because we're not having to build several hundred kilometers of rail or 100 kilometers of power line. So we can start smaller, generate cash, and then use that cash to self-fund a second phased expansion of the operation.
Another question that's been sent in, Matt. Interestingly, you've chosen to go back and undertake a PEA on this. That's despite advancing it earlier to bankable feasibility. Why have you decided to do this?
The main reason behind that, Andrew, is that we conducted a order of magnitude study with a third-party engineering consultant a little bit earlier this year, and it showed very, very compelling economics on the project, even at today's iron ore price. And we want to be able to share those results with our investors as quickly as possible. And because of the stock exchange guidelines, we're not allowed to do that without having a what's called National Instrument 43-101 compliant report. So yes, we do have all the information ready to do a feasibility study, but even just doing an update feasibility study would probably take us somewhere between 7 to 9 months and close to about $1 million to spend, whereas we can get a PEA out this year at a fraction of that cost.
I suppose ideally the big question, production. When would you like to be into that?
Oh, we'd like to get this mine back up into operation as soon as possible. So in order to do that, there's going to be several catalysts that will come out this year. One of them is of course, that PEA that I mentioned. We're probably looking at having that come out in the fourth quarter of this year. Another big thing is that we're in advanced discussion to acquire all of the surface rights where a mine is going to be located. So that should also happen late this year. Plus the surface rights from some land adjacent to us currently held by Ukraine's Ministry of Defense. And then rolling into next year, 2018, some of the big things that will drive the share price are going to be having an offtake agreement in place, financing agreements, and then having that feasibility study and all the permitting ready to start construction.
Just to elaborate on what you're saying there, Matt, we mentioned Metinvest a bit earlier, a deal initially being in place with them to aid in the construction of the mine. Are they still open to new deals?
I have had discussions earlier this year with Metinvest. To be clear to viewers, we did actually divest Metinvest. We own 100% of the asset as of early 2016. And that was done at our choice. And it was mainly because at the time, Metinvest was in a financial distress situation because all of their steel mills, their coal mines, unfortunately, are in that Donbass region where the conflicts are being held. Today, they're in a much better situation, though. Their iron ore mines are located very close to us. One of their mines actually is less than a kilometer to the east of our project. So it is possible that they could be interested to come back.
Very good. I mean, we've spent a lot of time talking about iron ore, but probably worth just spending a bit more time talking in a bit more detail. What's your outlook there for pricing? Where do you see it settling longer term?
Yeah, that's a very interesting question. I'm going to take a little bit of time to answer this one because I think there's some good context to give viewers. People should know that China is the largest consumer of iron ore in the world, and China imports more than they produce domestically. But what happened over the past few years that caused iron ore prices to depress is that you had some new production coming online by companies like Fortescue, BHP, even my old employer Rio Tinto. And China never shut down any of their domestic production, despite it being very uneconomic, like over $100 a ton. And the reason is by producing domestically and having a surplus of material in the market, they actually depressed the global price. And because the steel mills, by and large, own their own iron ore operating mine, by doing that, it actually resulted in a lower net price for them to do that. But things have started to change in China. One of the big issues in China right now is emissions. Pollution is a huge, huge issue in the country to the extent that how we get our daily temperature or weather forecast in China, in addition to that, they give the daily pollution forecast. It's that bad. Some days I've been in Beijing, it almost feels like you're in a fog storm. So this is causing China to actually shut down some of that really low quality production that causes a lot of emission. But what it's also doing that's interesting for black iron is it's also causing some of the lower grade, and when I say lower, I mean less than 62% iron content product, to actually get much larger penalties than what you've seen historically. But the converse is also true. In black iron's case, we're making an ultra high grade product, a 68% iron product, so 6% higher. And the premium historically was about $3 to $4 per 1%, but it's currently about $5 per 1%. So we'd get about a $30 premium over that current benchmark price. So today we'd be selling for around $105 a ton, which is pretty nice. In terms of the outlook on pricing, well, I think we're going to see near term probably around $70 to $90 iron ore. And people need to keep in mind that iron ore is priced CFR, which means delivered to China. If we see global oil prices start to recover, get back to say $60 plus a barrel, then you're also going to see shipping costs increase, which means the iron ore price is going to increase. And at that point, we'll probably see longer term more like $80 to $100.
And on the demand side, Matt, you see that remaining strong?
Oh, certainly. I mean, iron ore is used in almost everything that people touch in their daily lives. Iron ore, as you know, is the main input to make steel. So everything from the utensils that you had your breakfast with, to the car that you might have driven to the office in, to the actual office building I'm sitting in today that has rebar to reinforce the concrete. It's literally everywhere. I think the big shift, though, that we've seen is in China, say 5+ years ago, a lot of the iron ore was used to build new buildings for people to live in, because there was a big migration from the inlands towards the communities on the ocean. What you're seeing now, though, is a change more towards people buying white goods. So now that I own my apartment, I now need to furnish it. I need to have a washer and dryer. I need to have a dishwasher, chairs. The other big thing you're seeing is in places like the United States, major infrastructure spending. Particularly if Trump decides to build that wall, there's going to be a heck of a lot of steel and iron ore that goes into that. And then much, much longer term, I think what you're looking towards is places like India, where you've got a growing middle class, largely based on the high technology sector. But those people demand better living standards, better accommodations. So that's really the future of iron ore.
Very good, absolutely. So the future's looking promising for iron ore. You've got a busy and exciting second half of 2017 planned. How's the cash position? Plenty in the kitty to keep you going?
Yes, I mean, we were very prudent when, again, things started to downturn in 2014 to really curtail our costs. And we're currently sitting on around $5 million US in the kitty, which is more than enough money to complete all of those engineering studies I mentioned earlier, plus obtain the land that we need. So that cash should largely last us to a construction rate decision on the project.
That's brilliant, Matt. Just a final word from you for investors watching, looking at black iron. The uncertainty, I suppose, over the Ukraine situation, I'd imagine, has been a bit of a hurdle for you up till now. But why should they be watching on in encouragement? Why should they be as excited as you are about the potential here? Why should they consider investing, do you reckon?
Well, this is a company that used to have a $1.40 share price and is now 8 cents. And that's all because of the reasons that we talked about during this call, with Russia's invasion, with iron ore prices falling, for a team that brought this project to a near construction rate decision. So what I'd say is that all of those factors have changed now. We have iron ore prices rebounded quite nicely. They've held in there for over a year now, and everything's looking like it's only going to push up, again, because of the emissions concerns in China. We've got political stability with that front line in Ukraine, coupled with a very depressed exchange rate. So this is the ideal time for investors to get in and really ride that wave, because we've done it once, and we're going to do it again in terms of getting this project up to a construction-ready state, with the only difference being this time we're going to build it.
I like it, Matt. The ideal time to ride the wave. Very nicely put. Good to speak to you. Thanks very much for taking the time.
Thank you, Andrew.